Okay, well, it has been another week of record highs in the markets, and as we were mentioning, July now looking like a fairly solid month for the TSX with a return of roughly 2%. Of course, the U.S. markets have been rolling along as well. As investors navigate the trade uncertainty, we're now knee-deep in earnings stories, and investors are getting a closer look at how companies are navigating the profit picture. With stocks at elevated levels, what could the future of trading look like as we roll through the rest of the summer? Let's ask Dec Mullarkey, he's Managing Director of Investment Strategy and Asset Allocation at SLC. Dec, nice to have you with us. First of all, the simple idea of stocks being at record highs, does it surprise you?
Well, first of all, John, great to be on, great to connect. You're absolutely right. I'm surprised at the quick recovery. Our target for year end is still 6,500, and that's been there all year. So we still think this has to play out. But the key thing and what's coming through, and this has been the whole resilience of the U.S. stock market, is just the quality of earnings. Like they just have been stable. We're seeing that coming through already, and we can talk a little bit about that. But if you look as an international or global investor, there's nowhere else to go for earnings. Europe earnings are fairly soft, kind of flat. You see that same thing happen in Japan. So you can quibble about valuations, but when you kind of look at earnings, there's no question they're very, very solid. And we're seeing, again, we're early in earnings season, but we're seeing that coming through across the board in banks, some industrials, financials. So that's been the big story, is just the quality of earnings. And investors in these environments, they're looking for, reliable cash flow. And the U.S., certainly the S&P 500 is providing that.
So that idea of quality earnings, I mean, you mentioned cash flow. Is that it? Is it that, outside of the headline uncertainty, when we get this 3-month snapshot of what's happening with businesses, if the cash is still rolling in, then that puts to bed some of the worries about, the unknowns?
Absolutely. That is the critical thing. I mean, there's still a lot, though, to play out here. We've got to, you see already that the companies that have reported have handily beat expectations. Although the stocks haven't kind of moved in any significant way. Yes, we're at a high, but that's just inched up there. And really what that tells you is that coming in, expectations were pretty high, and valuations, of course, reflect that. And they are delivering, but it isn't moving the needle that much. But as we go through earnings season, the key thing that will come out, because what we've seen so far are mainly domestic companies, particularly financials. But as we go through the earnings season, a lot will come out to how companies are dealing with tariffs, how they're pricing, how they're passing along. And those stories, I think, will be a lot more nuanced. And that's where you could have maybe another leg up or a little bit of a correction at this point. So we're at that point, and I do think this will be a very demanding earnings season in terms of if you miss, you're really, really going to get penalized. And if you outperform, it's more like, thanks, we're expecting that. So that's where we are. So we will, this earnings season will be important in terms of setting the tone as we launch into year end.
Well, I almost get the sense that might be the story with Netflix today. I mean, we'll see how the day ultimately unfolds. They put together a very strong quarter, but at the same time, stocks up about 40% this year. So you have to measure all of that. Hey, Dec, I wanted to ask you as well, like when it comes to the interest rate story, I was referencing it as we were looking at the markets this morning. There's been a lot of back and forth this week on whether or not the U.S. Federal Reserve will be cutting interest rates at some point this year. So far this week, we've had news that would indicate a resilient economy, but there are other considerations there. There's the what if the job market starts to weaken. There is the what if of this ongoing complicated relationship between the current Fed chair, Jay Powell, and the U.S. President Donald Trump. What do you think happens with interest rates, and what does that mean to the psychology of stocks, in your opinion?
So in terms of the interest rate cuts through the end of the year, I mean, the market is somewhere between 1 and 2, and that's both for Canada and the U.S. I think it'll be closer to 1. I do think as we get to the end of the year, and if there's some visibility on where tariffs are going, and then just, will there be knock-on effects? So is it just kind of a one-time thing, or what will happen from there, and then do a couple next year? In terms of the impact on earnings, There is some, and certainly small cap benefit a lot more. Most of them are floating rate, but a lot of the, like say the S&P 500, have locked in terms on their debt, so they're in pretty good shape here. But you're right. There's a psychology issue where cutting rates, and they do need to normalize, and at some point if that needs to happen. So is it now or beginning of next year? It will happen sometime in that framework. That does help. It does help kind of in planning and expectation of where you're going. In terms of the cost of debt, I mean, the big story kind of away from that segment is really just the whole fiscal debt load globally. So you see 30-year rates really, really moving up. I don't think anything is going to change there. And I think we're in an environment, certainly at the long end of the curve, where rates are going to be high for some time. So that's not something the Fed can fix. That's fiscal policy and getting a lot more disciplined about what's going on.
Okay. Against that big backdrop, Dec, your lasting message to investors who are listening this morning on what they should think about doing with their portfolio?
I'd say stay diversified. One of the things that we saw in this quarter is a lot of investors shifted from single name and kind of niche-y plays into a broader index. That's the right play when you're in an environment where there's a lot of moving parts and you're not certain who the winners and losers are. But generally, you feel good about where risk is going and where growth is going. We're in that type of environment here where the direction is very solid. The pieces there could be hits and misses on some. So you want to stay pretty diversified. But North America is a great place to be, and put a plug in for Canada. They're one of the unsung heroes. They're outperforming a lot of markets right now. You talked about the 11%. If you translate a gain for the TSX, if you translate that into dollars, it's up 16%. So it's definitely been a star that's gotten overlooked.